Hello friends, welcome back. More on white noise process. So far, we all agree that an analyst as well as an investor should be in a position to identify or differentiate white noise from signal. When we make a model to make a forecast for any univariate series, there should be a presence of signal in its past data. There should be an absence of white noise in its past data. This is just a partial way of looking at it. Okay. Let me go back to the equation once again, and I have already introduced this term error to you. Okay. Now what is error? Error is something which has not been included in the model. In our case, what we have included? We have included the previous prices of Reliance in order to make a projection for the future prices. That is it. Right. So what is not included in the model is shown by this error or residual. Let's understand it more deeply now. What it conveys to us. When we work on univariate analysis, we work on a premise. Our goal is to make a good forecast. Given the constraints and limitations of the data and other things, we should be in a position to make a good forecast. And we are working on a premise that today's price of Reliance, whether it is increase or decrease, is a reflection of its past price, past to past price, and the lagged 1 year's prices. Adding to this theory is very important concept, that is, a price captures all the available information. Whatever is available in the environment is captured and reflected in the increase or decrease in price. I'll say it again. Whatever is available in the environment, internal and external, is reflected in the increase or decrease in the price of Reliance. That is a truth. On the basis of that truth, we are building up our univariate forecasts of time series. If that was not true, we would not be using, it would not be suggested that univariate time series forecasting should be done. So we are believing that every price change, whether it is on the positive or the negative side, is a reflection of whatever is there in the environment, and it has been captured and that it is reflecting in the prices. Let's take a simple example to understand what I'm saying. Reliance opens on Monday at 1200 per share. Okay, at 9:30 a.m. and it has to trade to 9:15 a.m. to 3:30 p.m. Okay. So this is the time period during which this Reliance price is going to face several blows from the environment, internal and external, good and bad. Let's assume today is the day of announcement of last 3 quarters financial results of Reliance, and investors have a huge positive anticipation. They have some kind of a reading and understanding about this company, and they view that these results, which will be announced at around 12 o'clock, let's say, will be very good. Their earning before interest taxes would be very high. Their debt is going to be reduced. They have future plans. They have had a deal with Facebook, so expansion plan, everything. It is going to reflect into higher dividend payout ratios for Reliance. So everything is building up on the basis of something which is revolving into the market. Because of this build up from 9:15 to 12 o'clock, before the announcement of results, the prices have risen 100 points. Now Reliance is trading at around 1300 points on the basis of anticipation of the people with respect to that price, with respect to the price of the company, backed on the announcements which are anticipated to be positive. At 12 o'clock, Reliance comes out with the numbers. There are analysts, reports, media, news coverage, everything is there. And it does not meet the expectations of the investors. Investors were expecting its profit before interest and taxes to reach some value, but it did not reach that. Suddenly we observe that the price of Reliance has fallen down after the announcement of results. Results are same, company is same, its performance is same, but what's changing or affecting the prices? Positive anticipation and disappointment at the time of announcement of the results and its reflection in the falling prices. So market price of Reliance from 1200 to 1300 and let's say back to 1100, it falls really sharp. In 1 hour, at 1 o'clock, it falls down to 1100. Is this price not the reflection of what's happening around? Yes, it is. Okay. Now at 1 o'clock, it is trading at, let's say, 1100. Right. Then there is a sudden announcement coming in the newspaper with respect to some kind of a approval given to some of its broadband business by the government. Okay. So Jio being one of the beneficiaries. So they feel, okay, great. Reliance has an approval which was pending approval from, which has got an approval which was pending from last 3 months. Oh my God, that's a good chance. No matter what the results were now, we can expect better results in the next quarter on the backing of this approval, which was very important for this company as well as investors. What is going to happen now? Something happened there, it gets reflected into the prices now. So it pushes back, okay, brings the prices up. Again, why these prices are going up? Because it is capturing everything and every positive, negative news with respect to the Reliance. Suddenly there is a news towards, let's say, 2:30, before 1 hour before the close of the market, that some of the plants have been shut down. They have now come into the red zone area or whatever. That has happened. So again, there is again a negative thing. So we are assuming that entire day, ups, down, up, down, up, down of Reliance price has actually closed in, let's say, at a figure which is, let's say, 1200. Plus minus everything has been reflected. Started with 1200, went up to 1300, brought down to 1100, then plus minus things are happening, and it is actually closing at the close of the market at, let's say, back to 1200. This is a rationale for choosing closing prices as for doing your analysis. Students ask me, why don't we take open price or average price? No. We work with the assumption of market closes after dealing with all good and bad during the entire trading session. That is the reason why we pick up the closing prices for doing the analysis. So closing price is a reflection of everything and anything that has affected that particular stock. And this is 1 day's closing price, and we have a series of previous 250 days trading closing prices of Reliance. We begin our analysis and run some modeling. Okay. So these 250 data points, which will go into making your univariate forecast, should not be white noise. The strength of error. Now, what is error here? Whatever is left over. Whatever is left over should speak less. Whatever is included in the model should speak more. In the subsequent sessions, I will tell you what gives strengths to error and what gives strengths to the model. But for now, we should understand that your error should be white noise. Your time series plots, data point, should not be white noise. Your error should not be left with some signals. Rather, everything should be captured in your stock prices. If that is not the case, maybe univariate time series analysis is not the right method of doing it. There is a lot of other information besides prices which is affecting the movement of Reliance stock prices, and you are not doing justice of adopting univariate time series at this stage. Then what should you do? Either go for bivariate analysis, multivariate analysis, pick up some other variables which are in the universe, kindly do some meet some experts, read, review, bring out those variables, put them into the model and do forecast. Why we have to do this? When your errors are stronger, your error is not white noise. Okay, so that's the significance of white noise here, in addition to several other things. This is not all, right? It gives us some indication that we may be going wrong. Okay, so how do you identify? We come to this conclusion: your prices, the stock prices of Reliance, should not show a white noise process, should not show white noise process, and your errors should show white noise process. What are the features of white noise? It is a process that is where the variables or the data points, 250 in our case, are uncorrelated, have mean zero and finite variance. All those 250 data points, with the help of any software, you can find out mean and variance very simply. Mean should be zero for it to qualify as a white noise. Variance can be anything, any number, but it should be finite. If it is 3, it should stay 3 throughout. It is 4, it should stay 4. So there should not be fluctuations in the variance. Variance is your difference from the mean. Okay. It should be uncorrelated. Which process is a white noise process? When today's price is not related to previous price. So for that, there is another thing that you should know is with respect to autocorrelation function. So autocorrelation function tells you whether your series is autocorrelated or not. Autocorrelation is relationship of today's price with its previous lagged price. Autocorrelation of 1 means today's price is correlated with its past day's price. Autocorrelation 2 means today's price is related to its past 2 days prices, right? Autocorrelation 3 means today's price is related to its past 3 days prices. So that is the nature. Okay. Our software gives you the result like this. Just look at the upper column. Don't look at the lower side of this. This PACF is related to the moving average process of time series, which we'll deal up later. For the time being, if you look at the autocorrelation function, how to get this graph will be taught to you in when you start playing with the software. But the outcome is this. It is showing, look at this. This is first lag, second, third, fourth, 5, 6, 7, 8, 9. Up to 9 lags. There is some kind of a relationship I can see. There are 0.5 plus minus bands, and it's going beyond it. Okay, to understand it here at this stages, if it goes beyond 0.05 here, that means there is a presence of autocorrelation. The series is showing some relationship, okay, because this is going beyond the bands mentioned here. Okay, so at this stage, let's just pause at its stage to refresh some more of our statistical concepts. Okay, then see you soon.